Good morning, everybody. It's Dave. It's Thursday morning, just after the Federal Reserve did their no change in interest rates on Wednesday. Not particularly huge surprise. I think no one in the world of finance was expecting anything to come out of the Fed yesterday, and had it done so, probably would have been a terrific disaster. Today, I'm going to just put a quick comment out on the fixed income market. A lot of impact, a lot of questions on fixed income. Pardon me. The liftoff with interest rates coming potentially in September. Still really on the fence on that. I think they're going to do it for no other reason than I think they have to. You've got some different kind of data points coming out. We just had GDP this morning that was revised, magically showing things to going up when it really didn't matter. They were revising GDP down. Um, but from a sort of quantitative technical perspective, it's an interesting look at the market for the bonds. The ETF signal that we use, so if a trader of this stuff, is we use the iShares. Pardon me, not the iShares. Pardon me. We do use iShares Core U.S. Aggregate Bond Fund, which is kind of like a mixed fund. I believe that it has a duration somewhere around like about 7-8 or so. So it's not as risky as, let's say, a long-term product, but it does bounce around. I've loaded it up on the screen in front of you here, and you can kind of see what it looks like. The interesting thing that I think of with bonds is that it's very similar look to bonds, going back about 2.5 years ago, when yields were making, very close to historic lows, or at lows, and so we see that as the inverse as the price chart. So as yields fall, prices rise. So the bond ETF will continue to rise. What we saw a couple of years ago was the fixed income market, um, continue to make itself up to some highs, and then begin to flatten out and start to roll over. And leading into that particular period, we had a bit of a market where, if you use the 2D approach, you can see down in here, the market was actually in a pretty good choppy type of environment. So there was cycling that was going on within the market, and then in early 2013, the market began to kind of break down. And what's interesting is that it's very similar to sort of where we are right now. We started to see the initial stages of the cycling, not necessarily working. We can see it here that where my cursor is, that we're breaking down below yellow, we're down below blue, and we're kind of at this point where this is sort of taking place. And where I think we are, in terms of an outlook, is I think we're at a place sort of like this late spring of 2013 where we can see the yield possibly, in this particular area here. And we what we might see is actually a little bit of an uptick short term. It looks to me like they're trying to make their push the prices a little higher. But the interesting development that we're seeing, and again it parallels back to 2013, is that this is kind of the first time that we've seen the bond market move from basically a trading market, because of the volatility that we see in the bond portfolio. It's never been something that has been a screaming buy. It's always been sort of something that's on the very low end of buy, but it's been in a trading range, so that it's been beneficial for investors. Obviously, you can see the upward sloping equity curve that just over the past 6 months or so, there's been almost a 6% jump, versus no change in actually buy and holding on the ETF itself, by following the algorithmic process of the signals that we see. But from a quantitative technical perspective, or quant technics, I would like to call it, the overall rank on bonds right now is 2, and so a 2 out of 10 is an outright sell. If you break down the components, the trend rank on the bonds is actually really negative. We have our bond timing models the longer term bond, we're at the longer term end of the range in terms of our cycle. So our longer term timing model is actually somewhat attractive at this particular point, but it tends to be potentially misleading, and it can tend to stay this way for a bit. So it's really best to look at longer term stuff in conjunction with the bigger picture, which is also with the trend, and which is also with the shorter term timing model. What we see with the shorter term timing model is that the bonds are basically 80% through their cycle, meaning that they're already had an upward wave that's basically been running for the last few months. Although all it looks like, if you can see the screen in front of me, is that you've had a downward move, and this last few month period where it's been up and down, up and down, up and down, it actually constitutes sort of the upward cycle in bonds. So there may be a little bit more upside potential, but all these factors contribute to the +2 rating, which is an outright sell. So and it's kind of the sort of the midpoint of the sell cycle. It's not a screaming sell, but at this particular point, what it tends to augur is that you have a much higher probability that you're going to see more downside over the next 1 to 3 months on the yield, much like we saw back in 2013, where it had very similar type of data, which is sort of weird, but that's how it looks. And then secondly, this would not be necessarily a point, even from a trading perspective, where we would look to sort of make a buy. And in longer term on the outlook for fixed income, we really have to see what the next few months are going to look like on bonds, and once it actually in fact does begin to get back to its particular downside levels. But at this point, we're a seller of bonds. We think that yields are going to continue to creep up. We think that bond prices are going to continue to fall. So again, quantitative rating of 2, not outright sell, timing rating near the top. So even from a short-term trading perspective, there's not a lot of potential on the long side here. And in fact, if you're going both directions, this is probably the best point that you could probably look to get a short sale. And much like in 2013, one just never materialized on our generic trading system at the top. There was a bit of a pop, but we just never managed to get the system to flip over. And that's usually kind of a hallmark of negative markets, that the equity curve begins to break down and drive lower, simply because there's no opportunity to sort of jump into a short trade. So at this point, not a lot of positive information on fixed income. Look for yields to rise. If you're interested in owning this particular security or ETF, there's probably going to be a much better time, and my outlook on that suggests that we're probably at a minimum looking at maybe another 6 months or so, and then we'll revisit as we go forward. Good trading.